Hello and welcome. I'm Amanda White, Director of Institutional Content at Connexus Financial, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to visit investmentmagazine.com.au and subscribe for a free email. And with that, please enjoy this episode. I'm joined today by Harsh Parikh, who is Principal in the Institutional Advisory and Solutions Group at PGIM, the global investment management business of Prudential Financial. Dr. Parikh heads the Real Assets Research Program and is also responsible for index-based solutions research. The IAS team conducts bespoke quantitative client research that focuses on strategic asset allocation and portfolio and asset class analysis across both public and private markets. Welcome to you, Harsh. How are things for you?
Thank you for having me, Amanda. Things are fine. A nice day today at New York.
Excellent. So in the current economic environment, there's a lot of discussion around inflation at the moment. And in fact, at our global event earlier in the year, institutional investors from around the world rated it as the number one risk to their portfolios. So today we're going to discuss the macroeconomic environment, including looking at inflation and the role of real assets in those different environments. Harsh, in your role at PGIM within the Advisory and Solutions Group, you work with investors on strategic issues, as I outlined earlier. Is this conversation around inflation coming up more regularly at the moment? And what are investors particularly worried about from the conversations that you're having? Can you outline your view of inflation, the outlook, and kind of what investors are wanting from you at the moment in this conversation?
Yeah. So to us, inflation is definitely on our investors' minds. And yes, some are really worried about it. In a recent webinar on inflation and real assets investing that we hosted with real asset portfolio managers from PGIM QMA, which is one of our investment managers, we discussed that their baseline inflation expectations has risen now to 2.3% for the next decade, compared to actual inflation of 1.7% for the last decade. And in addition, while some of the more recent inflation prints above 5% due to base effects and supply disruptions like semiconductor chips may be transitory, the risk to the upside inflation in range of 3 to 4% over long term has clearly increased. And that is what is worrisome for our investors, and particularly like what are the portfolio implications therefrom.
So let's expand on that a little bit in terms of the implications for portfolios, which is what we're really interested in. So in terms of protecting against inflation, there are various ways to do that, but real assets is certainly one way, and they play a big role. Are you finding that these conversations are increasing, that investors are more interested in their real assets portfolios than perhaps they were previously?
I would say yes. Our clients are increasingly interested in real assets. In fact, our research agenda in real assets took shape in last couple of years after a large public pension plan asked us about role of gold and gold-related assets like royalty agreements in their overall portfolio. And more recently, a large institutional investor inquired about comparing farmland and timberland assets with more traditional real estate and how to estimate their long-term expected returns. So yes, we are definitely getting a lot more inquiries now on real assets.
So what does that research agenda look like now at the moment, Harsh? You head up that real assets research program, and we'll come in later conversations to the framework that you've set up. But how is your research agenda evolving in response to some of these inquiries?
Absolutely. So as I mentioned, lately farmland, timberland assets are gaining attention, particularly from, I might come to it later, is like timberland has opportunity for carbon sequestration, and so on. So a lot of dynamics have been changing in some of these asset classes, and that makes our research agenda very dynamic, I would say. And sustainability is another topic that comes up. And of course, one of the things we did is last couple of years, the work we did on Rasa, we launched a tool, a web application called Rasa Interactive, so that this particular research can sit on an institutional investor's desktop, and they can work with that and understand the portfolio implications.
Yeah, we'll come to that in a moment, but I just want to talk a little bit more about the real assets asset class and the evolution of that asset class. You mentioned interest in gold and timberland. It seems like commodities are back in vogue.
Yeah.
Talk to us a little bit about the evolution among the asset class, and you mentioned sustainability as well, and people are increasingly interested in how to get to net zero portfolios. Can you discuss the evolution in the asset class, and perhaps with particular reference to sustainability and some of the things that you're seeing within real assets?
Yeah. So, Amanda, last year we noticed, based on 13F regulatory filings, that some institutional investors, like public pension funds, did allocate to gold and gold minor equity ETFs. In one of our upcoming research paper talking about our agenda, we looked at 15 large US public pension plans to see how their allocations to real assets have varied historically. And overall, allocations to real assets have increased from 10% to 15% on average in past decade. Real estate is still one of the dominant real assets, but average allocations to other real assets like natural resource, infrastructure, and farmland have also risen from 2.5% to 5% in aggregate. Now, clearly, the focus has lately shifted towards sustainability issues with large variability in climate, and with eyes set on COP26 in Glasgow this year. And real assets are by no means isolated. Now, this creates challenges and opportunities for investors, and separates winners from losers. So to give you an example, in farmland, which farms have irrigation infrastructure or water rights and which do not? Or as I mentioned earlier, the opportunity to sequester carbon, and real assets like timberland are large carbon sinks. Yes, of course, there are challenges around measuring how much additional carbon is sequestered and permanence of it. And in addition, I would say that risk management becomes very important, and perhaps even argues for investing in water and carbon futures to mitigate increasing water and carbon prices. And again, an example there is the NASDAQ Wheels California Water Index. Recently, it was over $900 per acre foot from $500 in the beginning of the year. Interestingly, though, this was opposite to the situation in Australia, where with drought-breaking rain, water allocation prices dropped considerably this year. And so I would say for real asset investors, geographic diversification is equally important.
It's absolutely fascinating, isn't it, how this asset class is evolving? And you mentioned water futures. That didn't exist 5-10 years ago. There's a lot of innovation going on. It must be an exciting place for you to be spending your time and research.
Absolutely. Although for water futures, the volume are still low, but we expect it to pick up. And of course, the carbon markets are fairly active.
So, Harsh, you've written extensively about successful investing in real assets, and as part of that, you outline that there are 4 key elements to success: get the sensitivities right, know your investment horizon, incorporate estimation uncertainty, and reflect your economic environment outlook. I really want you to spend some time on this. It's rare that you can actually really articulate 4 key elements of success in investing. So I want to spend some time on each of those 4 elements and outline specifically what you mean by each of these and why you think they're so important.
Yeah, thanks for bringing that up, Amanda. It's really an evolution in our research agenda. So the first element is sensitivities, and the sensitivities to inflation and growth differ widely across real assets and their sectors. So there's a great deal of diversity there. So for example, the 1-year CPI beta for commodities implies 17% up move for 1% increase in CPI level. Whereas for tips, their CPI beta suggests mere 2% up move for the same 1% increase in the CPI rate. So CIO who may wish to use real assets for aligning with certain investment objective should pay attention to these sensitivity differences. The second element is uncertainty. The asset sensitivities are inherently uncertain. So going back to the commodity example, while on average the 1-year CPI beta is 17, it really ranges from 8 to 14 at 90% confidence interval. Now, a CIO desiring inflation protection would likely prefer assets whose inflation sensitivities are more certain compared to assets whose inflation sensitivities are less certain. The third element is the CIO's investment horizon. An asset's sensitivity to inflation and growth differs depending on the horizon. In addition, the uncertainty in betas generally increase with the horizon. So again, a CIO may first wish to determine their investment horizon and then use those sensitivities that correspond to that horizon. And the fourth element recognizes that these sensitivities differ in various economic environments. So instead of taking the entire history to estimate sensitivities, a CIO can better estimate sensitivities for the specific environment of concern to them, like stagflation or overheating.
And so what I mean, you mentioned that there's particular sensitivities of individual real assets. Can you explain a little bit more about what that looks like with regards to the equity and bond markets and how it might interact with other parts of the portfolio?
Yeah. So the inflation let's stick with inflation sensitivity, right? So if you look at US equities, the inflation sensitivities of US equities would suggest for 1% up move in inflation, the equities may underperform by half a percentage point. And in fact, at a longer horizon, at 3 years, for the same 1% up move, the equities may underperform by 5 percentage points. And going back to our point of concern, when I say 1% up move, really brings the inflation in 3 to 4% range, as I talked earlier.
So you also mentioned earlier, Harsh, that in the Institutional Advisory and Solutions group at PGIM, you've developed what you call a RASA framework, which is the Real Assets Sensitivity Analysis Framework that incorporates all of these things. Can you talk us through how CIOs would use this framework, how it is already being used by institutional investors to inform their real assets portfolios and what the capabilities are and how they might be used by investors?
Yeah, so RASA is a portfolio construction framework which helps a CIO with the construction of real asset portfolios. And RASA brings together these 4 elements I discussed when constructing portfolios. Let me give you a concrete example, and this goes back to an investor who has inflation-linked liabilities. So, if the inflation were to go up 3 to 4%, as I mentioned earlier, right? So the equities may underperform by 5 percentage points over a longer horizon, and at the same time, the liability values are rising. And real assets, which are more broadly sought after for diversification and also for inflation protection, is something that investors can, using Rasa framework, construct a portfolio depending upon their inflation investment objectives.
It's such an important conversation at the moment, inflation, isn't it? I don't think I speak to any investors around the world without inflation coming up as an issue. Do you need to be a PGIM client to access this framework? Who's using it at the moment?
Actually, not. We are mindful, though, that large institutional investors get an access to this particular tool, and just Amanda, to give you an example of how some of the clients are looking at this tool, right? So, um, say over some clients are worried about overheating economic environment, which is where the inflation is high and growth is high. Then what they might look at through the tool would be the assets which would have higher inflation and growth exposures. And that might point to energy commodities, natural resource equities, real estate and REITs, infrastructure equities, and timberland. And some clients might be more worried for stagflation, which is an environment of high inflation and low growth. And they might consider assets like tips, gold, farmland, infrastructure, natural resource, and real estate debt. So, depending on an investor's investment objectives and views, their real asset portfolios and benchmarks will be different and often customized.
Yeah, that's so interesting. So the inputs as to what their sensitivities are or what they're worried about comes from the asset owner, and then the framework kind of helps in the portfolio construction of that. Are you guiding them at all in terms of a view around the outlook for inflation, or how do you talk to them about those inputs?
Yeah, so at IAS, we don't make the views. We let the data speak, and the research is very objective, and the clients are can provide the inputs where they are coming from, and use the portfolio construction tool.
And you mentioned the benchmark customization. That seems to be something that's particularly apt for investors, as they all have different needs and outlooks. Can you explain a little bit more, or give us some more examples around that customization that you talked about?
Yeah, sure. So say rather than using off-the-shelf benchmarks like Bloomberg Commodity Index or S&P GSCI, as the benchmarking technology has considerably improved, investors can now create their own bespoke benchmarks for real assets. And again, a concrete example would be a large plan in UK had an allocation to real assets for inflation protection, and they used an off-the-shelf benchmark. And this benchmark had high inflation sensitivity, but it was not well diversified and was concentrated in energy commodities. The other disadvantage of such benchmark is that it is weighted based on annual commodity production, and so its inflation sensitivity could really vary through time. And so we looked at trade-offs of concentration and inflation protection objective. And using Rasa, we recently proposed a commodity benchmark to them, which is relatively more diversified and with similar and consistent inflation sensitivity.
There's certainly a good argument for examining and potentially increasing a real assets portfolio at the moment, Harsh. But we can't sort of talk about this without examining some of the risks as well. What do you think in terms of the number one or top three risks are in terms of looking at a real assets portfolio that institutional investors should be paying attention to?
I would say the risks, as I would outline, are in some of the portfolio construction aspects. So not aligning the investment objectives and using a broader real asset basket might not cut it, and they may not be able to meet their investment objectives. Again, aligning their investment horizon. At a very short horizon, gold may not have a correlation with inflation, but at a longer horizon, it does. So not aligning your horizon could be just as harmful. And given that these sensitivities are very different and uncertain, so in your portfolio construction, a CIO may want to account for this sensitivity differences. And as I mentioned earlier about the sustainability and the recent attention to water risk and carbon risk, etc., is real. So paying attention there as well probably makes sense for an institutional investor.
Yeah, it's super interesting, Harsh. Thank you. You mentioned time horizons a couple of times, but then also that this framework incorporates all of those four elements you talked about. I'm interested in how dynamic it is or should be. Is this something that investors should be looking at in a tactical way, or is it a much more long-term sort of set and forget approach to the portfolio construction? Can you talk about the dynamic nature of it?
The intent of the tool is not tactical, and neither is it set and forget. The horizon, there is always a data limitation to our work. We go back far 30 years, and also for some assets, we could go back far to 70 years. So we have a lot of data to work with. But as the horizon gets longer, the amount of data we have, the sample decreases. And that means that for a CIO paying attention at 1 year, 3 year, and which is generally the rebalancing frequency or manager evaluation frequency, are the timeframes that we have in our mind when we think of this particular tool.
Well, it's super interesting. I can see how useful it is to CIOs who are examining some of these sensitivities and looking at the macroeconomic themes and the role of their real assets portfolios in that. So really appreciate you sharing your insights today, your very, very deep research and this framework that incorporates all of this. Harsh, it's been a pleasure to speak with you today. Thank you very much for your time.
Yeah, absolutely. Thanks for having me.